In trade war with the U.S., China holds a lot more cards than Trump may think. In fact, it might have a winning hand. Published April 11th, 2025, 2:12 p.m. Eastern Daylight Time, Linggong, Auburn University. When Donald Trump pulled back on his plan to impose eye-watering tariffs on trading partners across the world, there was one key exception: China. While the rest of the world would be given a 90-day reprieve on additional duties beyond the new 10% tariffs on all U.S. trade partners, China would feel the squeeze even more. On April 9th, 2025, Trump raised the tariff on Chinese goods to 125%. The move, in Trump's telling, was prompted by Beijing's lack of respect for global markets. But the U.S. president may well have been smarting from Beijing's apparent willingness to confront U.S. tariffs head-on. While many countries opted not to retaliate against Trump's now-delayed reciprocal tariff hikes, instead favoring negotiation and dialogue, Beijing took a different tack. It responded with swift and firm countermeasures. On April 11th, China dismissed Trump's moves as a joke and raised its own tariff against the U.S. to 125%. The two economies are now locked in an all-out, high-intensity trade standoff, and China is showing no signs of backing down. And as an expert on U.S.-China relations, I wouldn't expect China to. Unlike the first U.S.-China trade war during Trump's initial term, when Beijing eagerly sought to negotiate with the U.S., China now holds far more leverage. Indeed, Beijing believes it can inflict at least as much damage on the U.S. as vice versa, while at the same time expanding its global position. A changed calculus for China. There's no doubt that the consequences of tariffs are severe for China's export-oriented manufacturers, especially those in the coastal regions producing furniture, clothing, toys, and home appliances for American consumers. But since Trump first launched a tariff increase on China in 2018, a number of underlying economic factors have significantly shifted Beijing's calculus. Crucially, the importance of the U.S. market to China's export-driven economy has declined significantly. In 2018, at the start of the first trade war, U.S.-bound exports accounted for 19.8% of China's total exports. In 2023, that figure had fallen to 12.8%. The tariffs may further prompt China to accelerate its domestic demand expansion strategy, unleashing the spending power of its consumers and strengthening its domestic economy. And while China entered the 2018 trade war in a phase of strong economic growth, the current situation is quite different. Sluggish real estate markets, capital flight, and Western decoupling have pushed the Chinese economy into a period of persistent slowdown. Perhaps counterintuitively, this prolonged downturn may have made the Chinese economy more resilient to shock. It has pushed businesses and policymakers to come to factor in the existing harsh economic realities, even before the impact of Trump's tariffs. Trump's tariff policy against China may also allow Beijing a useful external scapegoat, allowing it to rally public sentiment and shift blame for the economic slowdown onto U.S. aggression. China also understands that the U.S. cannot easily replace its dependency on Chinese goods, particularly through its supply chains. While direct U.S. imports from China have decreased, many goods now imported from third countries still rely on Chinese-made components or raw materials. By 2022, the U.S. relied on China for 532 key product categories, nearly 4 times the level in 2000, while China's reliance on U.S. products was cut by half in the same period. There's a related public opinion calculation. Rising tariffs are expected to drive up prices, something that could stir discontent among American consumers, particularly blue-collar voters. Indeed, Beijing believes Trump's tariffs risk pushing the previously strong U.S. economy toward a recession, potent tools for retaliation. Alongside the changed economic environments, China also holds a number of strategic tools for retaliation against the U.S. It dominates the global rare earth supply chain, critical to military and high-tech industries, supplying roughly 72% of U.S. rare earth imports by some estimates. On March 4th, China placed 15 American entities on its export control list, followed by another 12 on April 9th. Many were U.S. defense contractors or high-tech firms reliant on rare earth elements for their product. China also retains the ability to target key U.S. agricultural export sectors such as poultry and soybeans, industries heavily dependent on Chinese demand and concentrated in Republican-leaning states. China accounts for about half of U.S. soybean export and nearly 10% of American poultry exports. On March 4th, Beijing revoked import approvals for three major U.S. soybean exporters. And on the tech side, many U.S. companies, such as Apple and Tesla, remain deeply tied to Chinese manufacturing. Tariffs threaten to shrink their profit margins significantly, something Beijing believes can be used as a source of leverage against the Trump administration. Already, Beijing is reportedly planning to strike back through regulatory pressure on U.S. companies operating in China. Meanwhile, the fact that Elon Musk, a senior Trump insider who has clashed with U.S. trade advisor Peter Navarro against tariffs, Swing has major business interests in China is a particularly strong wedge that Beijing could yet exploit in an attempt to divide the Trump administration. A strategic opening for China? While Beijing thinks it can weather Trump's sweeping tariffs on a bilateral basis, it also believes the U.S. broadside against its own trading partners has created a generational strategic opportunity to displace American hegemony. Close to home, this shift could significantly reshape the geopolitical landscape of East Asia. Already on March 30th, after Trump had first raised tariffs on Beijing, China, Japan, and South Korea hosted their first economic dialogue in 5 years and pledged to advance a trilateral free trade agreement. The move was particularly remarkable given how carefully the U.S. had worked to cultivate its Japanese and South Korean allies during the Biden administration as part of its strategy to counter Chinese regional influence. From Beijing's perspective, Trump's actions offer an opportunity to directly erode U.S. sway in the Indo-Pacific. Similarly, Trump's steep tariffs on Southeast Asian countries, which were also a major strategic regional priority during the Biden administration, may push those nations closer to China. Chinese state media announced on April 11th that President Xi Jinping will pay state visits to Vietnam, Malaysia, and Cambodia from April 14th to 18th, aiming to deepen all-round cooperation with neighboring countries. Notably, all three Southeast Asian nations were targeted with now paused reciprocal tariffs by the Trump administration. 49% on Cambodian goods, 46% on Vietnamese exports, and 24% on products from Malaysia. Farther away from China lies an even more promising strategic opportunity. Trump's tariff strategy has already prompted China and officials from the European Union to contemplate strengthening their own previously strained trade ties, something that could weaken the transatlantic alliance that had sought to decouple from China. On April 8, the president of the European Commission held a call with China's premier, during which both sides jointly condemned U.S. trade protectionism and advocated for free and open trade. Coincidentally, on April 9, the day China raised tariff to 84%, the EU also announced its first wave of retaliatory measures, imposing a 25% tariff on selected U.S. imports worth over 20 billion euros, but delayed implementation following Trump's 90-day pause. Now, EU and Chinese officials are holding talks over existing trade barriers and considering a full-fledged summit in China in July. Finally, China sees in Trump's tariff policy a potential weakening of the international standing of the U.S. dollar. Widespread tariffs imposed on multiple countries have shaken investor confidence in the U.S. economy, contributing to a decline in the dollar's value. Traditionally, the dollar and U.S. Treasury bonds have been viewed as haven assets, but recent market turmoil has cast doubt on that status. At the same time, steep tariffs have raised concerns about the health of the U.S. economy and the sustainability of its debt, undermining trust in both the dollar and U.S. treasuries. While Trump's tariffs will inevitably hurt parts of the Chinese economy, Beijing appears to have far more cards to play this time around. It has the tools to inflict meaningful damage on U.S. interests, and perhaps more importantly, Trump's all-out tariff war is providing China with a rare and unprecedented strategic opportunity. As always, Neural Pathways appreciates your viewership. Please consider liking and subscribing to stay up to date on everything that we share.